Ever found yourself puzzled by the term ascending triangle pattern in the stock market? This pattern, like many others, holds the key to insightful trading decisions. In this video, we're going to unravel the mystery of these patterns, focusing on the ascending triangle. We'll break down its formation, interpretation, and potential pitfalls, all with the aim of providing you with a clear, understandable explanation. So, stay tuned to decode this intriguing pattern and harness its potential in your trading ventures. So, what exactly is an ascending triangle pattern? Well, imagine a symphony. The ascending triangle pattern is like a crescendo in a musical composition. It starts subtly, builds momentum, and then culminates in a dramatic climax. But instead of notes and melodies, we're dealing with price levels and trend lines. The ascending triangle pattern is a bullish chart pattern that technical analysts frequently use. It gets its name from the distinctive triangular shape it creates on the chart. The top of this triangle is a straight line, known as the resistance level, while the bottom line, the support level, slopes upward. The resistance level is a price point that a stock struggles to exceed. This is where selling pressure overcomes buying pressure, halting the stock's upward movement. The support level, on the other hand, is where buying pressure overcomes selling pressure, pushing the stock's price higher. The ascending triangle pattern is more than just a shape on a chart. It's a visual representation of a tug-of-war between buyers and sellers, each trying to take control of the market. It embodies a key concept in economics: supply and demand. When the pattern forms, it's a signal that buyers are more aggressive than sellers, causing the price to make higher lows. This is a sign of strong demand. As the price continues to test the resistance level, supply starts to dwindle. This is because each time the price touches this level, it eats away at the total supply of sellers willing to sell at that price. Finally, as the supply diminishes and demand remains strong, a breakout occurs. The price bursts through the resistance level and the stock takes off. Much like the climax of our symphony, the ascending triangle pattern is a powerful tool in a trader's arsenal. It helps traders anticipate potential breakouts and make informed decisions. Now that you know what an ascending triangle pattern is, let's delve into how it forms. Scene script. An ascending triangle pattern doesn't just appear out of the blue. It forms over time. Let's delve into the formation of an ascending triangle pattern. Picture this. You're looking at a stock chart. There's a horizontal line representing a level of resistance. This line is drawn by connecting two or more price peaks that reach the same level. It's the ceiling that the stock price just can't seem to break through no matter how hard it tries. But here's where it gets interesting. At the same time, there's a second line, sloping upward. This line, the ascending trend line, is drawn by connecting two or more higher lows. This line represents increasing levels of support. It's like a safety net, catching the stock price whenever it falls and pushing it back upwards. So, you have these two lines, the horizontal line of resistance above and the ascending trend line below. Over time, they converge, creating a shape that resembles a right triangle. This is the ascending triangle pattern. Now, why is this pattern so important? Well, it tells us that although the stock price is struggling to surpass a certain level, that's the resistance, there's a growing demand for the stock. Each time the price falls, it falls less and less before being pushed back up. This is a sign that buyers are more eager to buy and less willing to wait for a lower price. The increasing demand, represented by the ascending trend line, is a bullish signal. But remember, the resistance level is like a ceiling. The stock price has tried and failed to break through this level multiple times. So, when it finally does break through, it's a significant event. It indicates that the buyers have won the battle and the stock price is likely to continue rising. So by understanding the formation of an ascending triangle pattern, you're not just recognizing shapes on a chart. You're reading the story of a stock. You're seeing the struggle between buyers and sellers and predicting who will win based on the clues left in the price action. Understanding the formation process can give you an edge when spotting these patterns in real time. How can you use the ascending triangle pattern to make informed trading decisions? This is a question that's likely been on your mind since we started unraveling this intriguing pattern. The ascending triangle pattern is typically observed during an uptrend and is considered a continuation pattern. This essentially means that this pattern usually signals that the upward price action is likely to continue. In the world of trading, this is an invaluable piece of information as it can provide a hint about the future direction of a stock's price. So, how can you use this pattern to predict breakout points? The ascending triangle is formed by a flat top line, which is the resistance level, and an upward sloping bottom line, which is the rising trend line. When the price breaks through the resistance level to the upside, it is considered a bullish signal and indicates a potential buying opportunity. However, it's important to note that the ascending triangle doesn't provide a clear indication of when the breakout will occur. It's like a coiled spring, building tension as the price moves between the resistance level and the rising trend line, but the exact timing of the release is uncertain. In addition, the ascending triangle pattern provides a price target. This is calculated by measuring the vertical distance from the first point of contact with the resistance level to the first point of contact with the rising trend line. This distance is then added to the resistance level to provide a potential price target. But remember, while the ascending triangle pattern can be a powerful tool, it's not foolproof, it's just one piece of the puzzle. It should be used in conjunction with other technical analysis tools and indicators to increase its predictive accuracy. Let's not forget, trading is as much about managing risk as it is about identifying opportunities. So, always ensure that you have a risk management strategy in place before making any trading decisions based on the ascending triangle pattern. Interpreting this pattern correctly can be a game changer for your trading strategy. But always remember, in the world of trading, there's no such thing as a sure bet. Always do your due diligence and stay informed. While the ascending triangle pattern can be a powerful tool, it's not without its pitfalls. Indeed, a common mistake some traders make when interpreting this pattern is jumping the gun. They may see what looks like the formation of the pattern, but it may not be fully formed yet. It's like seeing the first few pieces of a puzzle and assuming you know what the full picture is. Patience is key, as premature action can lead to unnecessary losses. Another mistake is disregarding the importance of volume. For the ascending triangle pattern to be valid, the volume generally decreases as the pattern forms and then increases during the breakout. Ignoring the volume aspect can lead to false signals and misinterpretations. Market conditions also play a crucial role. The ascending triangle pattern is a bullish pattern, meaning it signifies a potential upward trend. However, if the overall market conditions are bearish, the pattern may not play out as expected. The larger market trends can overpower the implications of individual patterns. Perhaps the most dangerous pitfall is the belief that any pattern guarantees success. The ascending triangle pattern, like any other pattern, is a tool, not a crystal ball. It can provide a clue, a hint, but it can't predict the future with absolute certainty. That's why it's imperative to manage risk effectively. One of the best ways to do this is by using stop-loss orders. A stop-loss order is a trade order to sell a security when it reaches a certain price. This can help limit your losses if the trade doesn't go as expected. Remember, the ascending triangle pattern is a tool to help you make informed decisions, not a guarantee of success. It's not about predicting the future, but about understanding the current dynamics and making the best possible decisions based on that understanding. Remember, smart trading is not just about recognizing patterns, but also about managing risks. So, you've learned about the ascending triangle pattern and how to use it in your trading strategy. This intriguing pattern, often seen in the world of stock trading, can be a powerful tool in predicting future price movements. Let's take a moment to recap what we've covered. The ascending triangle pattern is a bullish chart pattern that signals the continuation of an uptrend. It's a formation that arises from two distinctive trend lines. The upper line represents a consistent level of resistance that the price fails to break through, while the lower line illustrates increasing levels of support, indicating that buyers are willing to purchase the stock at higher prices. This pattern is a clear indication that buyers are gaining control over the market, creating a positive outlook for the stock. However, it's not a standalone indicator. It's crucial to consider other factors such as market conditions, company fundamentals, and economic indicators to make a well-informed decision. Moreover, risk management is paramount. Always ensure that you have protective measures in place like stop-loss orders to limit potential losses. Remember, trading is not about winning every single time, but about making more on your wins than you lose on your losses. With this new knowledge, you're one step closer to becoming a more informed and successful trader. Happy trading!